long term, the dollar is still very bearish. So any bullishness you see is temporary. That's why I was advising you yesterday that when you enter a trade from now till somewhere second week of January, don't target big pips. If you get 30, 40 pips, you are good to go. Get out of the market because it can likely come back to your entry. It can likely come back to your entry. This is obviously a fair value gap. There's one here too. That's why I was thinking Euro USD would trade into it. It came down, then it decided to do its stance. It went back up. There's a fair value gap. So one of the reasons I was anticipating that they will come down to fill that gap, then find support right here at 1.19157 go up. But the week just began, so let's see. It could likely trade back into it. It's possible. And you see, this is an example of a fair value gap from the weekly time frame. This Euro USD. This is it. This is a candlestick. This one. So the distance between the lower wick of the candle to the left and the upper wick of the candle to the right, that's a fair value gap. So you can see that when they traded into it, there was some reaction because Euro USD dropped today between during London session for about 119 pips. Traded into this bullish order block, then there was some form of rejection. It started going back up. So let's look for other examples. I'll get back to them later. Let me look for examples where price got filled. This is an example of volume imbalance that we'll be looking at here. So I will not get off this chart because I'm going to talk of volume imbalance next. Then we'll continue. I'm looking for examples of fair value gaps that go filled. Now, there's something you must know. The fact that when fair value gaps get filled, price reacts and starts to go in the opposite direction does not mean you should just make a trading decision because a gap is filled. No, the trend is the boss. That's why I always tell you that's the first thing you must look at. That's why I said you must understand market structure. If you understand market structure, it will be easier for you to identify trends. Okay, so if the trend is bearish, then fair value gaps that are in good sell zones are very likely to hold and the price will move down. But if the trend is bullish, fair value gaps that are in good buy zones are likely to hold and then the market will go up. But in a bullish market, if you see a fair value gap in a sell zone in that bullish market, it's not likely to hold because overall the market is very bullish. I hope you get me. So though these show us price inefficiency and imbalance in the market and gives us good ideas as to where we should enter our trades, we must make sure that the fair value gap is in conformity with the trend. Okay, so take note of that. I want another example of a fair value gap that got filled. There's one here, got filled, but it still came down to do a turtle soup sell model. So you would have seen the fair value gap, and you would have also seen or known that we have equal lows here, which is also a form of liquidity. We spoke of that one last week. So you would have taken note of this activity. So you see what happened. They filled the fair value gap, came down to clear the lows here. I bet you this was a double bottom. So anybody that sold on this line, there's a weekly time frame, sold on this line, if they were still holding on to their trades, would have had 184 pip drawdown. Most traders will be out by then because that is a lot. It's too significant. So anybody that's bought here would have their stop loss taken out. And very few traders will hold a trade for 184 pip drawdown. Most traders will be out by then. That's why I keep telling you, yes, double bottoms signal that there's going to be a buy opportunity. But you always have to wait for them to clear the stops or clear the liquidity there before you enter the market. So this is a typical example of them filling the fair value gap, clearing the equal lows, and then forming a nice turtle soup buy model. Then the market went up. Let me zoom out and see what was further left. I'm sure there was something there. You know what? Let me place a horizontal line here. I want to see why it reacted at that level. I'm sure there was something there. Yes, this is it. You see, that line, look, was acting as resistance here. You see that the market broke that line, traded right back into it, and then continued dropping. Then let's see what happened later on. You see, it respected that very line, and then it went up. That's why I was telling you some time ago that the market has got memory. It doesn't forget what it did even 20 years ago or even 50 years ago. The market doesn't forget. It has memory. So when it trades back into some of these significant levels, you are likely to see reactions over there. Good. Do you understand the example on fair value gaps? We'll look at what we call volume imbalance.